How does a valuation work and the significance of a valuation? What is a valuation? Whenever a financial institution lends to a consumer against a security, a valuation is always needed. This is so the lender has a confidence that they are not lending above what they should be against that property to the borrower. There are three types of valuations that a lender can request for: a full valuation, a desktop valuation, and an online automatic valuation. When is it needed? A valuation is always needed when a lender takes on your property that you're providing as a security. This is so they are not lending more than what they should be against that particular property. Regardless if the borrower is purchasing a property that is existing or off the plan, refinancing, drawing out equity, debt consolidation, or investment use, the lender is only able to lend up to a certain percentage of the property, which is generally 80% of the value of the property. The importance of a valuation and its value. Valuation should not just be seen as important to the lender, as doing a valuation is also important to the consumer if they are purchasing a property. Here's a few examples. 1. Say you're purchasing an existing property via a private treaty sale, which will provide you with a cooling off period or subject to finance clause. You just have enough savings for the 20% deposit plus stamp duty for $1 million property. You sign the contract for $1 million. Ideally, the valuation should come back at $1 million. However, if the valuation comes back at $950,000, what will you do? 1. You'll have to come up with the shortfall yourself. Let's say you want to borrow 80% with no LMI. The lender will only lend up to 80% of the value of the property, which is the valuation. Based on the lower valuation of $950 at 80%, the lender will only lend you $760,000. Now, you originally had $200,000 deposit, which is 20%. Therefore, $200,000 plus $760,000 loan means your total funds available is $960,000. Therefore, you're short $40,000. 2. You can pay lender's mortgage insurance. This is because you'll be borrowing more than 80% of the value of the property. 3. And your last option, you can rescind and not proceed with the purchase. Scenario 2. You want to know how much usable equity you have in the property so you can plan your next investment steps. Without knowing exactly what your property is worth and how much the bank will lend you against that particular property, it will be very hard to exactly map out what we could potentially do for you. For example, we could put a 2-year plan in place where your borrowing capacity allows you to buy 3 investment properties in the future worth up to $1.5 million in total, with a debt of $1.2 million, meaning you'll need around $300,000 in equity to use. However, if the valuation on your property only comes back at $100,000 worth of equity that you could use, then this conversation becomes useless and all the planning we put in place becomes irrelevant. Now, scenario 3, consolidating debts. Let's say you need to consolidate $40,000 worth of credit cards that's on 10% and a car loan of $40,000 on 6% into your home loan. This is so you can reduce the high interest rate that you're currently paying on these debts. To consolidate both of these loans into your existing home loan, let's say $500,000, meaning your total loan will now be $580,000. So you don't have to pay LMI. This $580,000 needs to represent 80% of the value of the property. Therefore, the valuation of the property needs to come back at least $725,000. However, if the valuation comes back at $675,000, then you might only be able to consolidate either the credit card or the car loan. This is because $500,000 plus $40,000 already equates to 80% of $675,000. Therefore, anything above that will incur lender's mortgage insurance. As a mortgage broker, we have access to different lenders that's able to do valuations upfront before we even submit any applications. Therefore, we have the ability to chase the higher valuation with different lenders. What happens when the valuation comes back low? When you go to the lender directly to obtain finance and the valuation comes back lower either with the purchase or a refinance, you either need to proceed with the purchase with LMI or not proceed with the purchase at all. Or make use with whatever usable equity you can take out if you're refinancing. How can a broker help? As a mortgage broker, we can order valuations with any lenders that's under our panel. Therefore, if the valuation on your purchase comes back short, we can order another valuation with another lender to try to obtain the valuation needed. Or we can order multiple valuations for refinances to try to obtain the highest valuation needed to draw out as much usable equity as we can for your financial needs. The benefit of using a broker is we can order multiple valuations to try to achieve the highest valuation possible. While if you go to the lender directly, they will only be able to order you one valuation. I hope you've learned something from this video today. As always, if we can assist you, please give us a call, and we hope to hear from you soon.